Peace talks between the U.S. and Iran have shown little signs of progress, and that means the uncertainty hanging over the Strait of Hormuz is likely to continue. My next guest says markets are underestimating just how fragile the global commodity picture really is right now. In fact, he describes it as grossly mispriced. From oil and natural gas to industrial metals and even agriculture, supply risks are building beneath the surface, raising questions about a new wave of inflation. We are joined now by Humza Hussain of TD Asset Management, and it's great to have you here in studio.
Happy to be here, Kim.
As I mentioned before, I can see you nodding while I'm saying these things, just, I guess, reinforcing how you feel about the risks. Why is it happening like this? Why do you think the market is grossly mispricing, in your words, what's happening in the commodity side?
I think there's a bunch of factors coming together, working together, conspiring together to keep kind of crude prices lower than they would, lower than you would expect them to be when you've had such a disruption. So I think the first thing is that I think we got lucky in the fact that we had a lot of sanctioned oil floating around, which conveniently became unsanctioned. And so you had this 150 million barrels that helped to cover some of the gap. And all that has disappeared. I think the other thing that is keeping prices lower is the volatility. And I think if you think about just day to day, like the tweets that were coming out, in the morning you would have a tweet saying, hey, everything is fine, Iran has agreed to everything. And on that same day, you would have Trump tweeting, hey, we're going to send them back to the Stone Age, right? So you had incredible volatility. You had crude moving $15 up, $15 down on a day. And so you had, pre-conflict, the volatility in oil was like 30%.
Yeah.
During the peak of this conflict, the volatility was 130%.
Can you explain this to me like I'm 6 years old? Because if you're not a trader, you say that, and I say, I understand volatility is higher, but I don't understand why that affects the price. Because
there are participants whose job it is to manage that risk or take that risk, right? And if I see an asset, if I see oil, and my target is, hey, I think this oil can move $10, so it has 10% volatility in a year, then I could put on a big position, right? If I think that's the normal movement, hey, it could go to 110, it could go to 90, I could put a certain size position. But if I see, if something changes in the world, and all of a sudden that volatility quadruples, and now I say, hey, oil could actually go to 140, or I could go to 60, or the next little while, then the size of my position is greatly reduced. And so that's exactly what was happening in oil. Like, people couldn't take the risk because regardless of which direction you were, the volatility was so high that if you were long oil or you were short sugar, you would lose money.
Right. So I'm just going to say this back to you. So if you're in the business of, again, buying futures or managing these things, you really bring down what you do because you can't bear the volatility in what you have to manage day to day. That's fascinating.
Yeah. And then I think the last factor that's kind of keeping prices, I think people are just looking for an opportunity to fade the risk. Like, if you think about the kind of the playbook over the last 15, 20 years, that playbook has been buy every dip in equities and sell every rally caused by geopolitics. And you've been right, and that's been the right trade 95% of the time. So I think that playbook is still the playbook that people are going to. And I think the world has changed. And I think that playbook doesn't work in this world anymore.
Why?
Because I think, like, that's a whole nother, like, 20-minute interview. But it's like...
Do it for me in 3 minutes.
The structure of how the world... You had the U.S. hegemon, right? They were a unipolar. That world is changing. Right? It's not unipolar anymore. They're also kind of retreating. And so you have, like, it's a multipolar world. And then you can see that in, like, reshoring, friendshoring, nearshoring. You see a lot of big themes in the world that are happening that have not happened over the last 20 years, right? The world is fracturing, in a sense.
Let me ask you, though, so I understand that and for what it's worth, agree in terms of where it's going. But when I think about going back to the oil prices right now, and part of the reason we haven't seen oil prices tick up commensurate with the risk that you see in the market, what's going to change that, in your opinion?
So I think you can only disconnect, like, the futures or the financial market from the fundamental market for so long.
Right.
And I think we are going into that window where you're going to start to see a convergence. So there is a difference in terms of, like, you have the financial price, the futures price of crude, and you have the actual price of crude when you go and you buy it. Right? So if I actually wanted to go buy crude today or tomorrow, I would have to pay, $120, $130, $140 a barrel. And so ultimately there will be a convergence because it gets really technical, but I can buy the futures and I can hold it until it expires in a month, and somebody's obligated to give me crude. And ultimately, like nobody's gonna let me buy futures for $100 and then deliver oil at their cost of $140.
Right.
Markets are gonna converge to the actual.
How long do you think that's going to take? And I guess it's a double-barreled question here. How long does that take if, let's just say, things were solved tomorrow? Because there's still, I know there's backlog, right? There's been some irreparable damage to some things.
Yeah. So, like, I don't know what's going to happen. I don't think anybody knows.
No one does.
But that array of outcomes at the extreme end is you get back into a hot war. But even at the most optimistic, say we declare peace right now and everything goes back to normal tomorrow. I think even through that process of peace, oil is going to grind higher for the next 35, 40, 2 months, period. Because if you think about we have like this empty pipeline right now, right? All the strait closed, I think 55 days ago. The last of the ships that managed to leave before the strait closed have essentially finished discharging now. If you open it now, there is a journey. There's a time that's going to take for ships to move out of the strait to their destination. So let's say on average it's 30 to 45 days. In that time period, nobody's receiving any oil. So the market is actually going to get tighter and tighter and tighter, even though we've declared peace and you see normalcy coming in like 45 days. But I think even in the most optimistic scenario, oil is going higher.
Can I ask you just before, because we'll have to go to break in about 30 seconds, but we saw news today about the UAE making a decision to not be part of OPEC. I mean, none of these things are related, but they all have an impact. So why should I pay attention or not pay attention to that?
I think this is related. I think it is related. I don't think it's a coincidence that it's happening right now while in this period of stress. So I think there's two separate kind of discussions to have on the oil side, on the balance side. Like I don't think it makes a difference in the short to medium term because right now the paramount concern is the strait is closed, right? And so it doesn't matter if UAE says, hey, I want to produce more oil. They can't. Like nothing changes. But I think what's more interesting is I think the political side is more interesting. I think like UAE has always held that as a bargaining chip against Saudi. So if they're kind of trying to get like political concessions or trying to get a little bit more kind of influence in the region, they've always kind of used that saying, hey, you got to consider our opinion despite us being like 1/10 your size, because if you don't, we're going to leave OPEC. So I think in the background, there is some disagreement that Saudi probably wants to do something, maybe sell oil in yuan, right? Maybe reduce American bases, and UAE is saying, okay, we don't like that, and we're going to, use our bargaining chip. We're pulling out of OPEC. I think something like that.
Fascinating. Yeah. We talked about oil, said a lot of fascinating things about oils. Let's talk about nat gas. And I think I was speaking with one of your colleagues talking about Qatar and just saying that I don't think they've ever missed a shipment. Yeah. And then, of course, this happened. So what's happening with natural gas and other refined products?
So, I mean, we don't consume crude. We consume, obviously, gasoline and diesel. And so the shortage is going to be felt in the products. Right? So right now, we'll be okay. North America will be fine. We'll have an issue of price, not availability. But in Asia, you already have an issue of price and availability, right? They're already rationing demand. So you're already seeing lots of flights canceled. You're seeing governments bring in like work from home mandates, 2 days a week. So things like that. I think that pain will slowly spread to Europe. And we've already started to see the beginnings of that as well, in the sense that I think Lufthansa has canceled like 20,000 flights through to the end of the summer. So that's where the shortage is going to be. The shortage is going to be in the actual product. We're focused on crude, but natural gas is maybe, I don't know how to put it, but could be even more explosive than oil in terms of the way it moves.
In terms of the price action.
In terms of the price action, right? So nothing has happened yet, but crude has storage, it has backup, it has lots of like places where you can load. It's very easy to move crude around. Yeah. Natural gas doesn't have those buffers, right? It doesn't have that storage. It's not easy to move natural gas around, right? And so when there's a shortage of natural gas, it's going to be much more acute. And so right now, I think we're getting by because we're in the shoulder season, so where there's no heating required, there's no cooling required.
We're going into summer.
Yeah, so a lot of people, so especially in Europe, you would be buying natural gas right now to build up your inventory to prepare for next winter. But I think that a lot of those buyers are just sitting back thinking, hey, this is short term, this is all gonna pass. I'll just like backload my demand, but this might not pass. right? I mean, and you're missing 20% of your LNG trade right now. So you might still be missing that 20% a month from now, or 2 months from now, or 3 months from now. And so if you backload your demand, you're going to need to buy a lot more gas at a time when there's shortage, at a time when you actually need natural gas for, because it'll be much hotter. So you'll be cooling. And so I think when that time comes, like we saw what happened when Russia invaded Ukraine, like if you need gas, you're willing to pay anything for it.
Yeah.
Like you need to cool, you need to heat,
Yep.
you need it, right? And so it hasn't happened yet, but I think maybe by the end of summer, you're going to see some fireworks.
Where else are you expecting to see some more supply shocks? I mean, you think about like fertilizer, softs, commodities.
So what the Gulf has is energy. They have abundance of energy, right?
Yes.
Because they have so much energy, energy is cheap there. And so it makes sense to locate a lot of energy intensive industry there. And so outside of like the first order effect is crude and natural gas, but you also have a lot of aluminum smelters because aluminum smelting is a very energy intensive business. And so not only are those smelters kind of blocked off from exporting any refined aluminum, they've actually been hit. So we don't know the extent of the damage, so we might be losing that roughly 4% of the global capacity.
Who does that affect the most, regionally speaking? I know India feels a lot of pain through this,
Yeah, I think generally a lot of the Gulf customers have been Southeast Asia and India.
Yeah.
So it's probably, like, I don't know for certain where that aluminum flows, but it's a global market.
Right.
Right, so aluminum can move around, just like all commodities. All commodities move around, right?
Yep.
So aluminum was already a balanced market, and a balanced market in commodities is a market that's ripe for moving higher. Mm-hmm. So if you're taking off 4%, that's potentially another tailwind for aluminum. The other energy intensive industry is fertilizer production, right? Because it's nitrogen. You're just stripping nitrogen from natural gas. So 30 to 40% of the world's nitrogen fertilizers come from the Gulf. So it's not an issue right now because we're going through the planting season. So a lot of farmers had already kind of pre-bought or pre-stocked their fertilizer at the beginning of the year. It will be an issue into the next planting season. So as we go into the fall, if this continues, then I think kind of the next kind of, I don't know, tailwind for broad inflation, right? We're going to have energy, then we're going to have metals. It's going to be agriculture next year.
Yeah, you can see how you just pull the string, and it's like you use less fertilizer, yields go down, et cetera, et cetera, et cetera. I've only got 30 seconds, but I want to ask you, how does this affect Canada? And maybe I could say that from like an investment thesis or from a inflation thesis.
So I think this is a golden opportunity for Canada. Not just this year, I think this is like the next 10, 20 years. I think what a lot of countries around the world have learned is that the importance of kind of national energy security and the importance of who you're trading with. And we can go out there and we can say, hey, we are stable, we are reliable, we have the rule of law, right? So our commodities should actually kind of demand a premium in the world. And so I think this is the time to make those long-term deals with, South Korea, with Japan. We can provide that LNG, we can provide those resources, we can provide those minerals, and we can provide it with tremendous stability for an extended period of time. So now's the time to make those deals, and it should bring prosperity to Canada.